We want to try to make this as informal as if we were meeting in person as possible. We are going to have a Q&A at the end where you can ask questions. If something does come up, though, I'd be more than happy to address it. Probably the easiest way would be to type into the chat box if you have a question during the presentation, and then I can address questions there. If I'm a little unclear of what the question is, then maybe you can unmute, and then we could just have a quick discussion on it. And then the other thing is, too, if everybody could just mute their lines just during the presentation, unless we get to a situation where we're talking or when we get to the end when we're doing the Q&A. So we can go ahead and get started. The first thing I did want to talk about a little bit is when I asked the question, why 4Gen now? And it's more of a question for me to address, and why Singular has decided to partner up. And I guess it was about 7 or 8 months ago when actually it was Michael Knight had introduced me to Jim Sugarman and thought we'd be a good connection just based on some discussions with that we had. And for our company, it's extremely important for us to work with partners that have the same vision and values that we have. And immediately after talking with Jim and understanding what their mission was, it really fell in line with what we're looking to do. I've been practicing as a CPA for about 12 years now. I've worked with public companies and private companies, large corporations, but in creating Singular, our focus has really been working with smaller businesses, whether it be startup businesses that are looking to grow, but it's really companies that don't have the internal resources where we're able to provide value. And one of the things we really enjoy is being able to share our expertise to groups like this in order to help you be successful with running a business. So, we're really appreciative to have this opportunity. And hopefully, as we go through the information that we have, that you'll find some value with that. So what are we going to do today? Why are we here? And when I first talked with Jim had asked, he had wanted us to come out and present some information as it related to the tax law changes. And in going through a lot of that, there's a lot of changes, more than most people are going to understand, that do have a significant impact on a lot of people, some don't. But the format that we thought would be most beneficial was to take pieces of it at a time and really apply it from a practical standpoint to how it's going to affect you as a business owner. And probably the most important area and the most questions we feel with new businesses and even existing businesses are, how should they set their company up in order to minimize the tax liability that they have? So what we wanted to do was to kind of go through the different entity structures and the different benefits for each one, and then also talk about how those tax law changes are going to apply, and it might change your decision-making process. One of the things I'm not going to address in a lot of detail is foreign entities or state taxes. Those are pretty comprehensive topics, and we're just going to stick to the actual federal structuring. But do understand, especially from a state perspective, it's important to understand your individual state laws when you're making a decision, as that could be impacted as well. So one of the confusing topics that we get often is people look at entity structures and they don't really segregate the legal side versus the tax side. And I just wanted to kind of create some boundaries around that. So when you set up a legal structure, what you're really looking to do, there's a lot of topics on that come into play when you're setting it up. But in a lot of cases, it's to limit your liability personally from your business. And just to clarify the legal structures, a sole proprietorship is generally a business that doesn't have any liability protection. Basically, you just open up a business under yourself personally and start operating. And then you also have partnerships, corporations, and then a more modern structure is limited liability companies. So it's just really important to understand that these are legal entities. And in a minute, I'm going to talk about the tax side, but just understand that these are the way they're listed and they're segregated, where you have some commingling when you get into the tax. When we talk about the tax side, there's a number of legal entities that can be classified as multiple types of taxable entities. The sole proprietorships are generally filed on your personal tax return, and there's different schedules that those are filed on. Partnerships are filed on a partnership tax return. Corporations can be filed as an S corporation or a C corporation for tax purposes. And then limited liability companies can essentially be taxed based on any one of those types of tax structures. So when you own a company 100%, if you set up a limited liability company, generally it's not going to be recognized from a tax standpoint. So when we talk about a tax standpoint, we're saying that it doesn't exist. You essentially just own the assets. You report your income and your expenses directly on your personal tax return. There's a separate schedule, which is a Schedule C. I had listed a Schedule E, which is for rental properties, but just to keep it simple, we'll just talk about it in terms of a Schedule C. Just some of the detriments to a Schedule C is that they do tend to get audited more frequently than other types of structures, like partnerships, S corporations, and C corporations. But in a lot of cases, they're a little less costly to file because they don't require a separate tax return. So one of the questions we often get is, I have a Schedule C, I report everything personally, should I file as an S corporation or a partnership? One of the things you do have to take into account is typically there's going to be a little additional cost if you're going to be filing as a different type of business structure. The next type of structure I'm going to talk about is an S corporation. And to be an S corporation, you have to file an election. An election can be filed by two types of entities. It can be a corporation that files to be an S corporation or a limited liability company. One of the things we run into constantly is when do you have to elect to do that? The rule for doing that is you're supposed to elect to do that during the year you want it to apply. So if you wanted to be an S corporation in 2018, you would have to send in that election by March 15th. But the IRS has made it very easy that if you don't do it by that date, you can really do it anytime. So if you haven't made that election and you don't make it till later in the year or even going into next year, you can still go back and make it very easily. So one of the things that comes up often as well is, should I file as an S corporation? And there's a number of factors which we'll talk about, but you don't have to make that determination earlier in the year. You can really wait till the end of the year. Even though you missed the deadline, it's really easy, as I mentioned, to go back and do it. So don't panic. So just to talk a little bit more about the S corporation. So the S corporation, you may have heard a term, it's also classified as a pass-through. And what that means is the income taxes are paid by the individual shareholders. So the company doesn't pay the taxes and write checks to the government on behalf of the company. The income from the S corporation is going to be reported on a personal tax return, and then you're going to pay that tax with your personal tax return. And typically, the way that it's done is that the company will make tax distributions. So you'll take money out of the company to pay your taxes because that's generally where all the cash is, unless you're taking out money regularly throughout the year. It does cause for a little more complexity than a C corporation because you have to identify how much tax the individual owner is going to owe and then make those distributions and make those payments. And then also, if you have a business that does that has activity in multiple states, it can be a little bit more complex when you're filing as an S corporation versus filing as a C corporation. The primary benefit that most people find filing as an S corporation is to minimize the amount of self-employment tax that you pay. A lot of business owners that start a business have come from the world of being an employee at a company. When you're an employee, you don't see the self-employment tax in a lot of cases unless you're really looking for it. That money's taken out of your check before you get it. So it's often a surprising conversation that I have with business owners when explaining that on their income, they owe income tax plus self-employment tax. And self-employment tax is the combination of Social Security tax and Medicare tax, which totals to be over about 15% of additional tax. And then once you make over about 120,000, it goes down to 2.9 to 3.8. So there's a large amount of additional tax above and beyond just the income tax. So what's the benefit of filing a tax return as an S corporation? Well, what you're allowed to do is when you file as an S corporation, you're considered to be a different entity from yourself individually, which is different from a partnership. So you're required to pay yourself salary. Well, the self-employment tax, or that 15%, only applies to the portion that's salary that you report. All of the other income after deducting the salary is not subject to that self-employment tax, as it is in most cases with a partnership. So you'll see in a lot of cases that people will set up their company, whether it's an LLC or a corporation, and elect to be treated as an S corporation so that they don't have to pay the Social Security and Medicare tax on the income outside of what they pay themselves as a salary. One of the gray areas that revolves around that is how much salary do you have to pay yourself? Because obviously the lower salary you pay, the less self-employment tax you pay. And just to give you some background on that, the IRS is very gray in saying that it has to be a reasonable salary for what you do for your job. And the process of them, if you ever go through an audit, they use a third-party valuation company to determine that. And then you would provide your facts to support, the salary that you have to make a determination of if it's accurate or not. What I usually tell people is, what would it take if you hired someone, to do a lot of the responsibilities of what you're doing, and kind of view it from that approach. There's no black and white answer for what the salary should be. It's just a discussion, and you have to get comfortable with the risks associated with that. One other item I just wanted to state, in businesses that don't have other employees, a lot of times you want to maximize how much money you put into a retirement account like a SEP IRA. And it's just one thing you want to understand is that with an S corporation, the SEP IRA contribution is limited to a percentage of your salary. So if you pay yourself a really low salary, like say $50,000, you're only going to be able to contribute 25% of that to a retirement account. So those are some of the things you just want to take into account when determining, a salary for yourself if you're going to anticipate on making a contribution. There are some limits as far as S corporations go. There's a limit to the number of people that can be invested in an S corporation, and then there's also a limit to the types of owners. One of the problems that I do see people run into, especially with startup companies, relates to companies that generate losses in early years. So we'll talk about the partnership side, but one of the things to understand is if you go out and you make an S corporation, and we usually don't recommend it if you're going to be in a situation early on where you're generating losses. And the reason is sometimes companies will go out and get debt. The debt is incurred by the business, and that debt's used to fund, capital improvements, capital assets, losses that are generated. Well, even if you personally guarantee that debt, you won't be able to deduct the losses. The only way you'll be able to deduct losses is if the losses are generated from money you put into the company as capital or loans that you directly make to the company. And it's tough to tell an owner, later down the road after the year is over that maybe they went out and got $100,000 in debt. They spent all that and created $100,000 in losses, and they have other income they could use it against, or they could take those losses and carry it back to an earlier tax year to get a tax refund and generate other cash, but they're unable to do so because of the S corporation structure. So that is a practical situation that companies run into in years where upfront where they're generating losses. You just want to make sure that if you are using debt, that you have the right structure in place so you can benefit from taking those losses. And then the last item with S corporations is you lose a lot of flexibility than what you have with partnerships. The requirements with the IRS are that all of your shares that are owned have to be equal owned shares for the most part. So if you have a business owner that owns 60% and one owns 40% of the stock, every time you make a distribution, you have to distribute it 60-40. All of the allocations, which means the income and losses from the business, have to be split 60-40, and you can't deviate from that. And then the other item is just restructuring limitations. With an S corporation, you can't go back to a partnership. You can, but if you have appreciable assets, like just say goodwill, your company's worth more than the assets that you have in the company, you're going to create a tax issue for yourself and have to report gain on that. So it really limits some of the ability to restructure. It doesn't mean you can't restructure and not pay tax, but it just takes a little bit more of a process and probably a little bit more cost working with professionals to do that. So next I'm going to talk about partnerships, and the two legal structures that create partnerships are, the first one is a partnership.
Really? I thought today is not too bad.
And then
it's actually warmer than the last few days.
And then the second one's limited liability companies. And limited liability companies that have more than one member are automatically classified as a partnership unless you elect to be an S corporation or a C corporation. So if you have a limited liability, which is the most common entity that's set up now, I would say, if you have more than one owner, it's going to be classified as a partnership. So similar to the S corporation, the partnership taxes are paid at the partner level. So it's the same way that the income is reported on the personal tax returns, and then it is paid there. Corporations can also be partners in partnerships, so the corporation would pay the tax. No tax on the federal side from an income tax standpoint is paid at the partner level. You can have state situations where it is. Generally with partnerships, and this is the detriment of why people usually select S corporations over partnerships in a lot of situations, is that all of the K-1 income or the business income is typically subject to self-employment tax if you participate or work in the business. I do have a distinction between guaranteed payments, and just to clarify, if you ever hear that term, guaranteed payments are as similar as salary to a partner. You're not supposed to do W-2 salary out of a partnership. Some people do, but it's typically supposed to be more like a 1099 where you just pay the partner and then you report those payments on their K-1, which also includes their business income. But to go back to the main point, usually all of your income from the business, whether it's salary or not, is subject to self-employment tax. There are some people, and it's more of an aggressive position, that will take the position that you pay yourself a salary and the rest of the income is not subject to self-employment tax, which is similar to an S corporation. I think you can take that position. Some people have lost, have gone to court and lost, and then they're also expected to have some more litigation that's going to really pave the way to disallow doing that in the future. It doesn't mean that you can't do it, but it's probably really risky if you wanted to take the same position similar to an S corporation where you just pay yourself a salary, pay the self-employment tax, and then on the business income, you wouldn't pay the self-employment tax there. The other item, which is similar to an S corporation, is if you're a limited partner where you don't participate in the business, there's some more detailed definitions around limited partners, but generally if you're not participating in the business, you're more of a passive investor, you don't pay the self-employment tax, but if your income's high enough, you might pay the Obamacare tax, which is 3.8% of additional tax on net income. There's no restrictions on who can own interest in a partnership. One thing that does come up frequently is people often will invest from their IRAs. It's important to note that investing in a partnership is different than investing in a C corporation for an IRA. So IRAs, generally, the income's not taxable until you take the money out. With partnerships and S corporations, if it's a regular business, generally it's going to be taxable. If it's a real estate activity, generally there's going to be some portion that's taxable, determined by how much debt you have on the property. The takeaway is just because you're investing with IRA money doesn't mean that it's not going to be taxable. And I've run across that issue sometimes where people are just unaware and they haven't been filing and paying their taxes. And obviously the penalties and interest can accumulate if you're not doing that. So if you're using any IRA money, just make sure that you understand that there could be some special rules with that. Is everybody okay as far as hearing me? Oh, okay, it sounds like there's some responses, but somebody had made a comment that it was breaking up a little bit. I just wanted to make sure that everybody's not having that issue. So as far as partnerships, and this is the difference, what I was talking about from an S corporation standpoint is when you have startup companies and you're operating in a loss, if the company takes out debt and you personally guarantee it, even though you don't put the money in, if that creates losses, you're able to take those deductions. You're also able to take out distributions against that debt. Where with the S corporation, as I mentioned, generally you're not going to be able to take those losses. And if you did take out any distributions against the debt and you didn't put money into the company, those are probably going to be taxable. So that's generally why a partnership, when you start a business, especially if you're not generating revenue and you're incurring losses, is probably a better choice because in a lot of cases, you are taking out debt through the company and you're personally guaranteeing that debt and you're able to take those losses. So it's an important distinction and it's one that needs to be made up front. So even if somebody tells you the S corporation's the best tool, and I've had people that go and file it before they've had a chance to talk with a CPA, you just want to make sure that you are talking with someone, whether it's formally or if you're out networking or at an event. Just get the details, because there's a lot of special rules that could really come into play that could affect some benefits of getting cash flow. So there was a question about the appropriate mix of salary and distributions. It really depends. It really depends on if you have other partners. If it's just you that owns the company, from a partnership standpoint or a single member LLC, if you were owning it 100%, you can really take out money. Either way, you're usually going to pay the self-employment tax on distributions or on salary. With an S corporation, as I mentioned before, you have to come up with a reasonable salary. So the mix would be whatever the reasonable salary is, and then you can take out distributions as you wish. If the distributions are coming from income that was created, those are generally going to be tax-free. The other issue is that if you have other partners or other owners, with S corporations, as I mentioned before, if you're 60-40, you got to distribute 60-40. Well, maybe, somebody's doing more of the work in the company. You can kind of get around that equal distribution by paying somebody else additional salary. So it really depends on a set of circumstances that you have. But in my mind, taking a distribution versus salary is essentially the same thing, from getting money out of the company and paying your bills and paying your expenses. But it's the underlying aspects of the S Corp structure, which requires you to pay a reasonable salary. And then the partnership or the single member LLC structure, that you can just take it out as distributions versus having to take out salary. Does that answer your question? Just going to wait and see if you had a follow-up. But as far as flexibility, one of the things you can do with the partnership is you can really write the agreement almost any way you'd like. It does have to have some economic rules behind it. If somebody puts in $100,000 and somebody doesn't put in any money and losses are created, generally those losses are going to get allocated back to the party that put the money in. And that's what I mean from an economic standpoint. And it makes more sense because, the party that didn't put any money wouldn't get to deduct the losses generally anyway, notwithstanding if there's any debt associated with the business. But one of the things is it does get more costly in putting together an operating agreement. The more special rules you put into the agreement, the more costly it's going to get with your attorneys drafting the agreement. And then the other aspect is it's just litigation. With corporations, there's a lot of corporate law protections for minority owners. With LLC agreements or partnership agreements, there's not as much case law. And then also and with anything really, anybody can litigate anything in an agreement. And it just tends to be that those agreements a lot of times they're not as clear as you'd like them to be, and it just leaves a lot of room for interpretation. And if things don't go positively, it can be very costly trying to sort it out at the end. Restructuring is a lot more flexible. You can take assets like property out of a partnership, and generally you're not going to pay tax on it, similar to what you would do for an S corporation or a C corporation. And then the other aspect is if you give somebody, I have a profits interest listed, which means if you have an employee that works for you and you want to give them ownership, in cases with stock, when you give somebody stock, if you're giving them actual stock, there's usually a value on day one, and they have to pay tax on that. If you give somebody what's called a profits interest, it just means they get to share in the profits of the company going forward. They don't have any value on day one. So generally, there's not going to be any tax to them. And in a lot of cases, they don't, the employee might not have cash to put into the company. So you avoid that tax issue on the front end where they're not getting any cash. They're just getting, stock or ownership, and then they have to come out of pocket with cash. Well, with the profits interest, you can just give them something on a go-forward basis so they don't have tax on day one, and then they just share in the profits and maybe the growth of the company on a go-forward basis. So it's a good flexibility to have, especially if you have key employees that you're trying to bring into the company. It doesn't mean that you can't do something similar in an S corporation structure. It's just the same thing. You have to get a little more creative in doing that to minimize the amount of tax that the employee or the company is coming out of pocket with. So as far as a C corporation, corporations, when you set up a corporation legally, they're going to default to a C corporation. And then from a limited liability standpoint, you can also elect to be a C corporation if you're a limited liability company. The biggest detriment to C corporations in the last number of years has been the double level of taxation. When I say that, you have the corporate level tax, which is essentially in the same realm as the personal level tax. But then when you distribute money out of the company, you also have to pay tax again. And that is why over the last number of years, you see very little amount of companies setting up as a C corporation because it just doesn't make sense. If you're going to be taking profits out of the company, you're going to be paying a lot more tax as well. So the other issue is that, kind of going back to the item that we talked about earlier, is that if you're in startup mode and you're generating losses, those losses will generally just sit in the business. You're not going to get any benefit to deduct those losses against other types of personal income to where you could create a tax refund or lower your taxes to where you get some instant cash in your pocket. They just will sit there and then they'll carry over until you have profits. The dividends also, if your income's up to a certain level, is also subject to the Obamacare tax, which would be an additional 3.8%. So that even pushes that tax even higher. There's no restrictions on the types of owners. And then there's a lot of flexibility. You can have different types of owners with C corporations where the profits are shared differently, paid out in different order. You can also do a lot of restructuring tax-free if it's set up appropriately. One of the benefits to a C corporation that really it came into play a few years back, it's been around for a really long time, but the actual practical benefit really wasn't there until they made some changes back in 2010, and then it was made permanent a couple of years ago, is the concept of what's called small business stock that allows you to exclude 100% of the gain if you sell the stock. There's some limits on that. It's $10 million, or essentially 10 times what you put into the company. But there are a number of rules that you have to follow to qualify. One of the rules is that the company has to be a domestic C corporation. And then when you put your money into the company has to have less than $50 million in assets to be qualified as small business stock. One of the other items is that it requires it to be an original issuance. And just to clarify on that, it's original issuance, not when the company started, but you have to get your stock directly from the company versus acquiring it through a third party. The stock has to be held by a non-corporate taxpayer, and then you also have to hold the stock for at least 5 years in order to exclude the gain. There's a number of types of businesses that are excluded, and most service type businesses are going to be excluded from being able to receive this benefit. And then there's some other industries like banking, insurance, financing, investing, as you can see, hotels, motels, and restaurants. So if you fall into any of these categories and that's your business, you wouldn't want to make a determination to be a C Corp based on this provision of being able to potentially exclude the gain if you sell the stock after holding it for 5 years. So, this is going to play a lot into whether you want to be a C Corp. And as we talk about the tax law changes here, this is one of the items you'd want to take into account, that if you're one of those companies that does qualify, I think it really makes a lot of sense to take this into account, even though there's a number of factors you have to meet, and it is a little bit of a gamble, as far as whether you're going to be able to hold the stock for 5 years, and is really the key component. So that's just to kind of refresh. Under the old rules, and a lot of these rules are still in play, the S corporation is really beneficial because you can exclude the Social Security and Medicare tax on the business income portion outside of your salary. The partnership gives you the most flexibility as far as being able to share revenue. You can bring in investors and give special types of deals, for them bringing capital in. And then the C Corp, similarly, you can also give them special types of deals if you're looking to raise capital. So, generally, if you're going to be looking to raise capital, you probably want to lean more towards having the flexibility of a partnership or a C Corp, so that you're not really restricting who you might have as potential investors. So let's talk about the tax changes. And the biggest one that affects C corporations is that the maximum tax rate is going from 35% down to 21%. And, on its face, it's a lot lower than the personal tax, but you do still have to take into account that you're going to have the double taxation when you make distributions. So if you're taking the 21% plus a potential 20 to 23% of dividend tax, you're still going to get up over 40%. So, what should you be taking into account when looking at whether you want to have a C Corp or not? And under the new rules, you should be looking at, how much money are you going to be reinvesting in the business versus taking out in distributions. And that's when we talk to our clients about analyzing, what type of structure they want to have under the new tax rules, you really have to run the numbers. And what we do is we run the numbers and we kind of take into account, well, if you take out 50% of the cash, if you take out 75% of the cash. But I really think, it really favors C Corps that are looking to retain capital in their company, reinvest the money. You're at a 21% tax rate. If you're looking to just cash out every year and take money out of the company, it's probably not going to make sense for you to have a C corporation. And then the other aspect in the back of your mind, you still want to take into account the small business capital gain exclusion, because if you're not paying tax on the sale of your stock, that could have a huge impact. So what you want to do is you have to look at the annual tax savings or tax out of pocket over time and have some type of anticipation or model that if you're going to sell the stock, how much tax savings are you going to get at the end of the day in order to be able to compare the different entity structures. But just, from my perspective is if you're a company that's going to be reinvesting capital and you can qualify under the small business exclusion, then it probably makes a lot of sense to really take a hard look at being a C corporation. So one of the questions that came in is just the 20% deduction. So I'm going to talk about that in a little bit of detail, but so the benefit, what they were trying to do with S corporations, partnerships, and sole proprietorships, and the question is, does it apply to LLCs? And when we talk about LLCs, if you remember, an LLC is not a tax structure. So when we talk about partnerships, S corporations, and sole proprietorships, if those are legally structured as LLCs, that will apply. If you're an LLC, which is usually rare, that elects to be taxed as a C corporation, it wouldn't apply. So it's based on your tax structure versus your legal structure. But to answer the question, yes, it does apply to most LLCs. One of the other things that you have to take into account when analyzing the cash flow between doing a C corporation and doing a partnership, S corp, or sole proprietorship is that the state income tax deductions that you're paying are going to be limited now at the individual level. The total tax you can deduct on a personal tax return is $12,000, and that's a combination of property taxes, real estate, and like your car taxes, vehicle taxes, which are usually minor, and then also income taxes. So if you're making a lot of income, your state taxes are usually going to exceed what you're going to be allowed to deduct, especially if you're in a state that has a really high tax rate. So the corporations will still be able to deduct state income taxes. So when you're comparing business structures, and if somebody's putting together cash numbers, you want to make sure that you're taking that into account in the C corporation structure, that you're going to get the benefit for deducting those taxes, where on the other side of it, you're probably not going to get much benefit. So I'm going to talk a little bit more in detail about the 20% deduction. So the 20% deduction, we're just going to talk about the exclusions really. Generally, it's for the income that comes through from partnerships. If you file a partnership return, if you file an S corporate return, or if you file as a single member LLC, which is a Schedule C or sole proprietorship, which I talked about earlier, it is going to be based on your taxable income. But the 20% deduction is attached to the business income that comes from those activities. It doesn't include investment-related income like capital gains and losses, dividends, or investment interest. If you have interest from your business for funds used in the business, or like if you're in the business of lending money, that would be more business income. Investment interest is just more of just your money sitting somewhere and generating interest income. So it doesn't include what you pay yourself in W-2 income and guaranteed payments. So, another reason, if you're paying yourself less W-2 income, then you're going to have more business income where you can take the 20% deduction. So there's a lot of factors you want to take into account. This also impacts, your salary. The official tax rules are that you can't determine salary based on tax implications, so it's important to understand that. But as long as you're in a reasonable salary range, you want to make sure you're taking all of these factors into account. One of the things that that they think is going to happen is you might have a lot of employees that now want to be considered independent contractors. If you're an employee, you don't get that deduction. If you get a 1099, you run it through a business, then you do get the 20% deduction. So you might have people that are employees of yours that might want to be considered independent contractors for taking these deductions. One thing to really understand is that there are technical rules around who's an employee and who's not an employee. So if somebody comes to you as a business owner and says, hey, I want to be a 1099 contractor, and you just say, yeah, and so you give them a 1099 and just pay them their 1099 income, but don't treat it as salary, And when I say salary, you have, as an employer, you pay the self-employment tax, half of it, and you're supposed to collect their half and collect their withholding tax. If you go through a payroll tax audit and they determine that that person qualifies as an employee, then you're on the hook for those taxes. So you just want to make sure that, just because somebody wants to be a 1099 contractor, you just want to make sure that once they are, that they meet as many of the requirements as they can in classifying them as such. So it is a legal definition. It's not just what do I want to be. And it's just important to know that as an employer, that you want to make sure that whoever you're treating as an independent contractor there's not any risk, or if there is risk, you're aware of the risk that they could be classified as an employee. So who gets the 20% deduction? And one of the groups that have been excluded from that are service-related businesses, most service-related businesses. One of the areas that has been excluded from this, but included as a service company for being able to take the deduction, is like architectural and engineering firms. And we get a lot of questions on why that would be. There was a deduction in place prior to 2018 for companies that manufacture, produce equipment or property. There was not a percentage deduction that they would get based on the revenue generated from those activities, and engineers and architects were a part of that. They've gotten rid of that deduction. So I think that leaving their inclusion and being able to take this kind of keeps it in line with the deduction they were previously getting. But in general, most service companies are not going to get the 20% deduction against their business income. And that's once you exceed $157,500 of taxable income if you file single, or really any classification other than joint married returns, which you can go up to $315,000. So I think, I think it's good, because a lot of people said that, the tax bill just affects the high earners, but it was good to see that they put this provision in, for people that are running smaller businesses that don't generate as much income. Even though they're a service company, if their taxable income's under those amounts, they'll still get that 20% deduction, which is essentially getting their tax rate down to about 25% or so. So for everybody else, outside of those service companies, there's a limitation once you get over those same numbers, the 315,000 or 157,000. And the limitations that come into play are based on W-2 wages and then also acquired property. As far as the W-2 wages are concerned, you can kind of understand now you've got another factor in determining, in your W-2 wages affecting how much tax you're going to pay, what kind of deductions you're going to get. So that's why it's critical in really understanding, what your range is for reasonable salary, and how much, running the numbers with the salary in that range to determine, how to maximize your benefit. Sorry, I'm just reading a question. Yeah, somebody asked if you're a subcontractor and you receive a 1099. If you're a subcontractor or a direct contractor, from a tax standpoint, it's the same thing. If you're getting a 1099 in both cases, you just look at yourself individually. You get the 1099, you're the service provider, and then you report the income either on the Schedule C on your personal return, or you elect to do an S corporation and pay yourself a salary. Usually in making the determination of going to an S corporation, you usually want to have business income that's going to be in excess of a reasonable salary, because that's the point you'll start saving on the self-employment tax. And then you just want to take into account the extra cost of running payroll and also filing an additional tax return. It's a common question to know, should I do an S corporation? Well, you really want to wait till you're really getting a benefit on the self-employment tax side before you do that. But just to go back to your question, if you're a subcontractor, you get a 1099. It's the same thing as if you were the contractor getting a 1099. You just look at your personal situation. So just finishing up, so if you earn a lot of money, you're not excluded as a service company. there's going to be some limitations as far as how much of that 20% deduction you can take. You just want to make sure that when you're determining your W-2 wages and, if you're going to acquire property through the year, how those limitations are going to come into play. And, most of my clients, we're looking at just taking, a reasonable salary that's kind of probably on the lower end, and then maybe adjusting your salary at year end with a bonus. As I mentioned, the IRS doesn't like you determining salary based on the tax implications, so you just want to make sure that you're coming up with a salary that fits in a range that's reasonable for what you do. And, it's very gray. So it's just really understanding your risks and making sure you're aware of that. I think just as far as the new tax laws, they're really driven, for reinvestment. I think, as you can see with the C Corp tax rate going down, other businesses that'll reinvest capital that are really getting the benefit from these tax deductions. And then really companies, smaller businesses that aren't generating a lot of taxable income. So if you're a service-based business and you're doing really well, you exceed the 300,000, you're not getting as much of a tax break as some of the other types of businesses. But, it's really generated at driving some of this money back. And they just feel like those types of businesses and industries are really what contribute more to the economy from a financial standpoint. So, that's all I had as far as what I wanted to present. And, we can open the floor for some additional questions if people have questions. My contact information's on the screen. The point of doing this, obviously we're all trying to make money and run our businesses, but truly and honestly, we really like helping people out. We're trying to bring value maybe to smaller businesses that don't have the resources internally or, the cash flow to go out and hire, a really large firm with a team of, lawyers and accountants that become very costly. We have a lot of expertise and we're more than happy to answer questions. We're very responsive. And, even if it's just giving us a call or sending us an email, I'm more than happy to answer your questions anytime. So with that said, if anybody has any questions, I'd be more than happy to address them. Hope everybody's not sleeping. I'm just kidding. Well, thanks. It sounds like someone's typing, so I'll wait and see.
Hi there, can you hear me?
Yes.
Okay, great. I had to end up logging in via the phone. I have a question. I am an LLC, and I was recently told about being able to file for the tax status for S Corp. I'm possibly thinking about turning this into a holding company to like my ultimate branch off and maybe doing like some DBAs under it. Would that ultimately change the ability to file as an S Corp? In the long run, think about that before I start branching off of the LLC.
Yeah, well, you want to make sure that the types of different businesses, if you're doing different types of businesses, would still fit, within the structure. But generally, if you're doing, you can have a DBA, or what you can do is you could set up LLCs 100% owned by the S Corporation. So you could do individual LLCs. And from a federal standpoint, as I mentioned before, they don't exist. And that it works the same way if the S Corp owns it versus an individual owning it. So if the individual owns an LLC 100%, they report all the activity on their personal return. If the S Corporation owns 100% of the single member LLC or 100% owned, it's treated like it doesn't exist. So everything just gets reported through the same S Corporation. There can be some state implications depending on what state you're in that do recognize a 100% owned LLC separately. But generally, if all of those DBAs are going to get the benefit from being the S corporation, you could do separate LLCs, owned by the S corporation from a legal standpoint, but it would still be treated as one company from a tax standpoint.
Great, thank you.
Well, I think, Jim, you had posted a question for Michael, but he just mentioned he had to jump off. So if there's no other questions, I just want to thank everybody for joining. I'll talk to Jim about getting the slides, or if we're going to post those up. I'm fine either way with doing that. So we can get that information to you. I'd be happy to do that.